Right. All right, everyone. Welcome, everyone. We're extremely thrilled to have you join today's webinar, launching the results of our fourth Future of Work study. My name is Kyle Verbomen. I'm an associate partner at Urbanite Advisors, calling in from beautiful Montreal. So just a brief introduction. Urbanite Advisors is an independent consultancy specializing in location and real estate strategies. We're 5 years young already. And we assist both occupiers and investors in optimizing their real estate footprint and essentially adapting to the evolving demands of hybrid workplaces, which is essentially what we're going to be introducing today. Just high level, our services include workforce planning, HQ portfolio strategy, workplace strategy, and urban development marketing. We aim to deliver a positive urban impact by helping clients rethink their locations, workplaces, and investment strategies. Just introducing our speakers for today, we have Luca Sicard and Tomasz Polster, our partners and co-founders of Urbanite Advisors. I'm making the introduction, essentially moderating the Q&A when it arrives. Luca and Tomasz will be deep diving for the next 30 minutes into the latest findings, helping to level set our understanding of hybrid workplaces for today. I encourage everyone, please, to keep yourselves muted, cameras off. For the meantime, we'll kickstart our Q&A. If you feel like it, please drop a question into the chat. I'll address those first at the end, as is the rule. But at any point towards the end, raise your hand and we'll get to your question right away. So essentially, a key aspect is beyond the findings of our report and the surveying that we've done, we're constantly referencing our data to our global projects that we've conducted over the past several years. Everything is ramping up very, very quickly. A lot of questions from the market, and we're aiming to deliver those. And these findings help us in supporting our projects globally. So we're very thrilled to have so much participation. What's also important to note too is that we're aware that there's a lot of noise in the market. But what's important to address is that much of the noise that we have in the market is not necessarily grounded in fundamental data. The study is essentially backdropped with employer data and very much representative of the market. So without further ado, just to, as I see we're 5 past, I'm going to hand over to Luca and to Tomasz to guide everyone into the data, and wishing everyone a great webinar. Thank you very much.
Thank you, Kyle. Maybe you can jump straight away to the next slide, please. So what we can see, first of all, is that the big return to office announcements are not fully reflected in the data.
Hi, everyone. Can we just encourage everyone to stay muted, please? Unless someone else can mute them.
Let me check.
That will happen sometime.
Sorry, Luca, you're muted as well. You have to unmute yourself.
Okay. Okay, so what we can see is that the big return to office announcements are not fully reflected in the data. Instead, the remote working allowances continue to slightly increase year on year, now reaching on average 2.6 days per week. TMT companies are leading the way, providing the highest remote allowances at 3.2 days per week. From a geographical point of view, again, despite some big news coming from the US, this country continues to see the most generous with 3 days per week, followed by the UK at 2.8 and Europe at 2.5. So what it tells us is that companies continue to balance the employees' flexibility and autonomy with in-office presence and collaboration, rather than enforcing and pushing a one-size-fits-all model. Okay, if you can go to the next slide, please. So if remote working allowances are increasing, what about the actual office attendance? Well, the data shows that the office attendance has now been stable for the past 2 years at around 40%, with peaks of 50 to 55%. And that compares with average attendances of 60% and peaks of 70 to 75% pre-COVID. These rates are consistently below the mandated return to office policies in nearly all the industry sectors. And this demonstrates a clear signal that employees are making choices based on their productivity and their work-life balance rather than on their strict office mandates. And interestingly, sectors like finance and law, which historically required a higher in-office presence, are seeing the same trends as other more flexible industries. And therefore, rather than fighting against these realities, we now see companies needing to rethink their space strategies to reflect the actual usage. Next slide, please. So one of the key responses to this attendance is the rise of desk sharing policies. Today, we have 63% of companies with a desk sharing model in place versus 55% last year. And this number is expected to continue to increase and reach 70% by the year end. Companies with larger workforces, what we call companies with more than 15,000 employees, are adopting more aggressive desk sharing ratios under 0.6 when the average is close to 0.7. So this transition from assigned seating to desk sharing needs to carefully be managed because the poor implementation can quickly lead to frustration, decreased collaboration, and a lack of identity in the workspace. Next slide, please. So one of our new additions this year is what we called the Workplace Rigidity Index, which measure how flexible sectors are, and ultimately companies, in allowing their employees to choose where they work. It considers 4 key elements. Firstly, the required number of office days, and then the ability to work abroad temporarily or permanently. And finally, whether companies have a policy enforcing and measuring the office presence. So if we dive into the results of this index, Kyle, if you can move to the next slide. So here our data shows 2 distinct trends. On the left, you see sectors like the TMT and business services that are adopting less rigid policies, i.e. offering flexibility and lower in-office expectations. And these policies are more attractive to talent, but result in lower office occupancy. Whereas on the right, you have industries such as the public sector, industrial, FMCG, and law that enforce more rigid policies, requiring their employees to spend more days in the office. And while these policies may be less appealing to talent, they lead to higher occupancy rates and greater benefits for the landlords. So organizations must weigh their priorities, whether that is fostering talent attraction with flexibility or driving their occupancy up through rigidity. So the right approach will depend on your industry and your strategic goals. And if you are an occupier present on this call, this tool can really allow you to benchmark your flexibility against your peers, your competitors, and make more informed decisions about your workplace policies. Next slide, please. So what does this mean for real estate and ultimately cities? Well, understanding how different sectors and company sizes approach occupancy rates and space reduction is critical in shaping your future office strategies. What our data is showing is that on average, companies plan to reduce their real estate footprint by 13%. You can see differences depending on the industry and the company size. But what we see is that companies year on year are implementing their planned space reductions. 2 years ago, the estimated footprint reduction was 16%, and last year it went down to 15%. Some sectors, like the public sector, TMT, and FMCG, are the ones showing the highest footprint reductions. On the other side, interestingly, despite some high remote working rates, the sectors like financial services or life sciences are not reducing their office space as drastically. Maybe that indicates a stronger need for physical collaboration and potentially some regulatory considerations. The trend is also clear when you look at the company size. For larger organizations, more than 15,000 employees, these companies are planning the most significant reductions at 17%, followed by the mid-sized firms at 11%, and the smaller companies, less than 50 employees, they are showing the least reduction at 5%. So what it shows is that really the smaller firms still rely on physical presence for culture, for collaboration and operations, when the large corporations can better leverage hybrid work to optimize and reduce their cost. So ultimately, the real estate footprint of the future will depend on how companies can balance their flexibility, their efficiency, and the needs of their employees. The challenge is not about reducing space, but it's also about ensuring that the right space is available for the right purpose. So I will now leave Tamas to present the location, real estate, and urban impact.
Thanks, Luca. So what does this all mean for our portfolio, our cities, and our neighborhoods ultimately? And one of the aspects that is very well under research, and by the way, this whole topic is massively under research. If you just think about the fact that there is no city in Europe, except France, that is measuring the entire office portfolio within the country. Believe me or not, it's the only one, and they've done it recently. So let alone understanding the impact of this whole hybrid working on our cities and locations. And we believe this is way more important than the impact on real estate. So, we of course asked the respondents, how do they see the impact on recruitment, on where they will deliver space for their employees? And 17% of the respondents mentioned that they are actively recruiting beyond their current countries of location. So they are recruiting people in other geographies. 23% say we are recruiting within our existing countries, the countries where we're present, but in other geographies. And 60% say there is no change. There's another figure we're actively monitoring for a few years now, and that is the total amount of fully remote positions, because on the previous chart, we just addressed the physical location of employees that have to come to the office. Here, it's about how many people companies are recruiting that don't need to come to the office at all. And if you see the percentages, you might think they're low, 3 to 8%, but multiply that by over 200 million people working in Europe, 150 million working in the US. It's a bloody high amount of people that will be allowed to work anywhere, basically anywhere in the world. And these are very, very significant figures. And you see some of these are, growing further. And basically, you like it or not, this is a talent pool that all our clients, employers like you, have to tap in. If you decide not to recruit fully remote, well, another company will take those people. So this is, again, another element that supports our thinking around we will not be able to reverse hybrid working and remote working, because otherwise you just lose this massive talent pool. So that's around, remote working and location. Okay, so, in terms of your workplace and location policy, we see that, and this is part of the rigidity index, 4% of employers, allow their employees to work from a completely different geography, another jurisdiction, another country. And again, 4%, well, what is 4%? Well, 4% times 200 million employees, that's a lot of people. And again, why do employers now on average allow 4% or 4% of employers allow their employees to change country? Because it's a demand from employees. This is a trend we've seen in the US. In the US, 4 or 5% of white-collar employees change state every year. In Europe, this is coming as well. And either you follow the trend or, again, you lose the employees that want to change for whatever personal or professional reason. 27% allow their employees to work from another country temporarily, and we see this during summer holidays. You can work an additional 1 or 2 weeks from the location that you spend your holidays from, or for any other reason. Of course, 40% allow their employees to work from another building within their portfolio, and 31% are introducing co-working as a core element of their wider portfolio strategy. So you see much more diversity in locations, allowing a much more dispersed workforce. So, to the opposite of what is happening in the industrial sector, reshoring, we believe that in the services and white-collar employment, we will see a further globalization of the workforce, allowed and empowered by remote working policies. Of course, when you recruit a more dispersed workforce, you tend to favor central locations. And this is fundamentally because, many of us, all of us, every morning vote. We all vote in the morning. Unless you have something to do in your office, you decide, will I go to the office, will I not? And if you have more things to do, go to a shop, go to the cinema, meet colleagues, friends, you will have another reason to come back to the office. And employers, of course, realized this trend and started to move back to more central, more accessible locations where there is more to do. And of course, there are differences sector by sector, but you see a massive vote for central locations, 86%. Okay, so what does a central location mean? I think it doesn't mean the same things as it meant a few years ago. And I started to work in real estate for 30 years ago, and not much has changed in the way research is done around real estate, around rents and real estate trends in the office sector. It's all clustered into these office districts that have been designed by someone on a, I was head of research in one of the big brokerage firms, and it was designed by someone on the desk. Okay, I think Soho will look like this, and central business district of Manila will look like that. There hasn't been much thought about that, and those sectors has remained when you would access real estate research. It's all clustered around these neighborhoods defined 30, 40, 50 years ago, when real estate was responding to a very different trigger. When those districts driving our research still available today, what mattered in location was proximity to some highlights, like, if you were a bank, you wanted to be close to the central bank or the stock exchange. And basically, the financial district, became the CBD, and that was the location most in demand. That was the most expensive location in town, the CBD, Central Business District. Well, we think that's completely outdated, because today it's not as before the employer who decides where you work. You decide where you want to work. There is a very strong element in companies deciding to locate where they believe their employees will want to come. Because again, I don't know what it is in your company with your clients, but the number one, number two challenge in most of the services sector organizations is to have their employees back to the office. And you might try forcing them, but a better way is to make sure that you put the infrastructure, the location, the policies for them to come back more, because every hour they spend on, at their desk or at the meeting room with their colleagues is a very productive hour. That's an hour where you're more likely to win new insights and new creative outputs. So again, big focus on having employees back. So with this being said, we developed an index which is called the Vibrancy Index, which measures the attractiveness of cities according to what employees will find in those locations to do beyond work. So, that is a reflection of how attractive those locations will be for employees. We will not go into the details, but we cluster all cities in the world. We've done 100 cities, 160 of them, around hexagons of 500 meters, and we measure how employees rate those locations, what services they have, and accessibility, and those are ranked systematically and consistently, and you can compare them. And you see that the locations that have high vibrancy, and if we take the example of New York, where we work a lot, 60% of our projects are in the US, you see that, for example, Soho has a high vibrancy. It also shows a much higher return to office rate. Soho now, Midtown is at 71% of pre-pandemic office attendance, whilst Lower Manhattan Financial District is at 57. So you see this translating into figures. And again, maybe Soho is a bit more expensive today, but again, if you have a few more hours of your employees per week, that's worth those dollars per square foot. So what is the right recipe for a great location according to our survey and our project work? Definitely connectivity and urban amenities that are aggregated into our vibrancy score. And also, of course, having a mixed use environment. Our research and our project demonstrate that neighborhoods with more than 50% of offices, so office dominant neighborhoods, will see lower return to offices as well. And by reverse, they will see a lower vibrancy because it's very difficult to deliver a vibrant neighborhood if the only public you have in the neighborhood is office attendants or office workers that come between whatever 8, 9 until 5, 6. And by the way, also an element of the post-pandemic, return to office rate, employees tend to leave earlier than before. So there is also more volatility in their attendance rates. So again, a neighborhood where people leave after 5, it's very tough to make it vibrant. So obviously, you will see with our research and your own, day-to-day work that, we believe return to office rates are at a plateau, or we don't believe we see office rates are at a plateau for 18 months already. So we are at this 40%, it was 39% last year, so no big change. So yes, some people come back more, but it's not massive. So we're left with a lot of square meters that are unused. And, as consultants, as employers, as investors, we have a duty of care towards our shareholders to align our footprint to our real needs. And I don't believe we can say, oh, let's wait because we will make this change and we will be back at the old normal. People will come back. No, we believe they won't, at least not for the coming couple of years, maybe a decade. But that goes beyond that. That goes beyond the duty of care towards our shareholders. That goes also towards our duty towards our cities and communities. Because if you think about it, the respondents to our survey, 100 plus organizations occupying 27 million square meter, 270 million square foot of office. They are planning to reduce this footprint by 3 million on a very prudent way, by the way. We think that these 3 million over the next 5 years is a very prudent assumption. We see in our day-to-day work that, when you tackle this element of aligning to the post-pandemic workplace, you can reduce even more and companies reduce more. But anyway, that's the minimal number. That's a bloody lot of square meters. Because if you extrapolate those 100 companies to, let's say, the entire European office market, which is slightly below 1 billion. So we have, according to our estimate, and I don't think there is much or many estimates in the market, we believe there is roughly 1 billion square meter of offices, not investment grade. It includes the offices in cities that are not researched and not part of the figures from the big brokerages. That's also offices that are owner occupied, still attended only at roughly 40% of the time. So there is a very easy potential within the next 5 years to reduce this billion square meter or 10 billion square feet of offices by 120 million. 120 million square meter we sit on, we absolutely don't need today and will not need in 5 years. So that's just to give you, a very quick, figure. That's roughly around 1.8 million residential units, housing close to 3 million people. And we are in the middle of the largest residential crisis since the Second World War in our major cities in the US, in Europe. So a lot of people are looking to be are looking for some decent accommodation, and we sit on a lot of square meter offices that we're not using. So, a massive responsibility of us, as real estate sector to cope quicker with this change in remote and hybrid working of our companies. So with this in mind, if you're an investor and you're sitting on, a number of invested offices, yes, you will inevitably lose some clients, you will lose some square feet. I mean, on average, of course, some might do better than others, but what can you do to keep and retain your clients? And this year we asked our companies, so these 100 organizations that are occupiers, not investors, what are the key priority for them when they choose to remain or they choose to go to a new office? What are the top 5, criteria making them decide to stay or to go? We were very surprised by the fact that the ESG, the environmental and social credentials of the buildings, that increased significantly since last year. Is that due to the obligation to declare scope 3? Is it just a greater awareness? And maybe we'll see some changes between the US and Europe, but definitely by far the number one criteria mentioned by our respondents was we want to remain and go into buildings that have the right environmental or ESG credentials. And we want to make sure the landlords are delivering those certificates. And that's a significant increase since last year. The second, and we were even more surprised on that, we do this in and out. We advise companies on how to make their buildings more active mobility friendly, but it came as a second. And again, probably to do with scope 3 emission declaration, when you know that 60% of your emissions are related to commuting and only 40% to buildings, then you realize that putting the right infrastructure in place is really important, not only for your emission, but also for the health and well-being of your employees. So having buildings with the right infrastructure in terms of active mobility was number 2. And then, of course, you see parking is still important, especially in the US and across Europe, of course, as well. But it now came after active mobility, interestingly. And of course, reflecting the fundamental change in the way we use our offices, we use the square footage, is offices, and I don't need to say this because this is bread and butter now, offices become places of collaboration, meeting, and innovation. So the availability of shared space in forms of meeting, co-working, and catering, supporting this is fundamental for your tenants of today and tomorrow. Not only providing them meeting space in their offices, but having shared meeting space in your buildings is definitely something that companies, occupiers are looking at. So this being said, as a recap, a few trends. First of all, as we already mentioned, return to office rates are stable, increasing very slightly, 38, 39% last year, 40, 41% this year. So the figures in our very significant statistical base are not reflecting a lot of the noise that Kyle mentioned in the beginning of, I will not use quotes from very famous people keeping us busy these days, but if you're not coming back, you're fired. Maybe, but that's not the average employer. That's not the average corporation. So still people showing up 2 days a week and companies providing around 50% of remote allowances on average, and that keeps slightly increasing. Rising, I mean, as a direct consequence, office vacancy is going to rise further. We like it, we dislike it. That's a fact, and I think today the big brokerage firms started since last year to also recognize this. Their figures are also showing very similar increased vacancy rates. So we are going to be left with a significant amount of office space that we have a duty of care towards our societies to quickly change use. And the first duty we have, it's not as strategy consultants, but that's a duty of care for valuers. And we believe, sorry for the small focus here and maybe hobby horse, but valuers in Europe especially have to revalue their client stocks. This has been done very quickly in the US. In the US, office buildings have been revalued based on the new realities. In Europe, it's, as you know, it's moved. So, valuers are taking a few years before the office value is allowed to reach the real market value. And that is blocking transformation and reuse into residential. So it makes us sit on empty square footage. You guys, I don't know, but when I cycle in the cities where I work, it's incredible the amount of empty square meters. So act now. It will deliver financial benefit for us as an occupier and fringe benefits for society. Interesting new focus this year, rigidity index. I think, when I started to work 30 years ago, working at PwC, the office of a consultancy was massively different from, let's say, an IT firm. And then over the last decade, it all merged. Everyone was behaving in a very similar fashion in terms of workplace and real estate. The offices of Google or Barclays Bank was starting to look alike. Well, now, since the pandemic, is diverging again. So we have significant differences in the way companies behave towards return to office and workplace, because they have a different attitude towards return to office. They have a different workforce, and it's very important that we measure, compare how we behave, how our clients, how occupiers are behaving towards return to office and hybrid working. And we see very different, as you see in law firms, as Luca mentioned, very traditional. They are back in the office, small organizations or larger financial institutions where they have a very relaxed policy. This is important to understand the impact on your portfolios, but also on the neighborhoods and the cities. A neighborhood that is exposed to companies with very flexible workplace environments or less rigid workplace policies will face lower attendance and will need to reinvent themselves quicker. And finally, a very, very big shift since last year towards ESG initiatives and ESG responsibility, not only in terms of aligning your footprint, but also into measuring the impact you have on your emissions, but also on your neighborhoods in terms of delivering the right portfolio and the right square footage at the right location. So these are some of the key conclusions from the study. And with this, I hand back to Kyle for further insights and Q&A.
Thank you. Thank you so much, Tomasz. I've heard you say this a million times, but even still, after this kind of webinar, I learned so much. So it's fantastic. Thank you so much for guiding us through and guiding everyone through. So just to end, once again, just with a reminder in terms of how we can help you, workforce planning and portfolio strategy, just in terms of what you could take away, redefining how and where your teams are work while maximizing efficiency. We're there to essentially help you specialize in your relocation of your global workforce and realigning your footprint, asset positioning and active score certification. We've dived a little bit into that. Your buildings deserve a glow up too, and we want to assist in helping you reimagine your office assets and really stay ahead of the tenant trends and implement the learnings now into a real asset, giving you that cutting edge that you deserve. In terms of how you can access this report, we've uploaded the key findings already to the website. The PDF will be uploaded soon, but if you're keen to get a copy of the report, please do email us, get in touch with us on LinkedIn, and we'll be happy to forward you a copy of the PDF. It's chock full of incredible insights. If you want to learn more, of course, and get to know some more of those details, we'll be very happy to schedule a phone call with you and dive in a little bit closer to the results. So with that, I'm sure we have some questions. I'm just going to stop presenting, sharing the screen. I wonder if we actually have some questions in the chat. I'm just going to check. Oh my goodness, so many people on the call. So I'm seeing some, I don't know if that's Finnish in the chat, so I'm not going to be able to translate that directly. So apologies on that. I don't know if we have any direct questions from the audience. Feel free to unmute yourself or even put yourself on camera if you want. It's a kind of an informal discussion if you'd like. If no questions, actually, my first question to the speakers, we could say, is how can companies strike that right balance between reducing office space and maintaining a strong company culture? I don't know if that should go to Luca or Tomasz. Whoever wants to take that.
I think, but I don't know, happy to start. It's a question we hear a lot, and there's again a lot of noise around, balancing the one and the other. I think you need both. You need people back in the office, especially in certain functions. That's why it's important to understand which sector and which workforce you're addressing. There's nothing to replace in-person collaboration, and that has to be defined based on what you do and your workforce. And for a law firm, it's going to be very different from an IT company. You have to find your right balance, but there is a balance. There is nothing like fully remote will work, or nothing like 5 days in a week in the office will work. So it's a very personal balance for your team and your organization.
Great. I don't know if anyone else wants to chime in on that point. If not, let's say second question. Given the trend of larger firms reducing space by up to 17%, how do you see this impacting real estate demand in major urban business districts?
I think some of that was already responded by Thomas when he shared the recipe for success. Definitely the office dominant districts will suffer. And while the large corporations are reducing their footprint, they are also rethinking their locations. They are prioritizing the prime, well-connected areas that will attract talent and offer a strong workplace experience. And that means that the traditional office demand may shrink, but the high quality, flexible buildings with rich amenities will remain in demand. And we're starting to see landlords and developers adapting their buildings by repurposing them into mixed-use space, a bit as we saw on the slide showing the criteria requested by tenants, but they will integrate co-working areas, retail, hospitality. So what we're going to see is a transformation of these business districts, and overall the office sector will evolve towards a more dynamic, service-orientated model, and the landlords and investors that can adapt quickly will remain competitive in this new and evolving landscape.
Thanks, Luca. We have a question from Bernard, who thanks us very much for the webinar. You're very welcome. How do you see the work of architects and interior designers in supporting the creation of work environments that meet the expectations of tenants?
So happy to take that. I think, on interior designers, it's quite an obvious one. I mean, interior designers are, at the center of understanding, the needs of the tenants and redesigning their workplace. I mean, of course, it depends what you mean by interior designer. That needs to be including the workplace strategy. So fundamental, workplace strategy and workplace design is fundamental to reshaping, the environment of occupiers. Architect is a more complex one because the problem is, and I'm an architect by trade, an urban planner initially. The problem we have with the profession is that there is a sequencing of the development, and architects many times have been out of sync with the real users of the building, because in most Western markets, buildings are not anymore designed by occupiers, they are designed by investors. Investors themselves are a bit lost into, what should we do? And many of them still think that, this is all bullshit, this remote working, we will see everyone back. If you see, by the way, CEOs in big real estate development companies, they force 5 days a week on their employees. They seems to be not fully in sync with what's happening. So the architect is even beyond that. I don't say at all that the architects don't understand what's happening, but they are a bit out of touch because they have several layers between them and the real user. Then you have the developer, the investor, the broker, and then they don't know who the building will be for. So I think architects, they are in a difficult position, definitely today. But that's why we are in a collaborative environment. We work with architects day in, day out, and they bring a lot of value into understanding building sustainability. And we and others bring this understanding of occupiers maybe a bit more than architects do today.
Thanks, Bernard. We have a question from Attila. Attila, do you have any information on what asset classes drive returns when legacy offices are repositioned? And essentially a follow-up, is there a district asset class that could drive the revitalization of the office-heavy district?
The answer is very easy. There's only one, or the most important is residential. Without residential, the problem is very simple. If you want vibrancy, if you want amenities, you need residential, either within your neighborhood or at close proximity, because only residential can bring you the quality and the time coverage of services that will make the neighborhood vibrant. A restaurant that is only making a living out of lunch at midday, it's very hard to provide the right quality. If you have the evening residents coming from the neighborhood, usually your margin on the evening meals are much higher. People drink more. They don't drink during the day. Not say that it's a good thing to drink, but anyway, so residents will bring the ability to deliver quality amenities. So the number one focus should be residential. It's not easy, but there is a positive circle or a positive consequences from having residential.
And
All right,
maybe what I will add to that point, and is taking the example of London, maybe the King's Cross district that went through a reconversion. It's a district that lives, so it's good to have a multifunctionality, but you need to have a constant effort of organizing services, events during the day, but also during the night. And that really creates a community, not only of office workers, but of residents, of tourists. This office district or mixed-use district really become almost a touristic attraction and a place to work, live, shop, and that lives 24/7 almost.
Thanks, Dukan. Great questions, everyone. Hopefully, I see we have quite an international audience, so hopefully everyone can take away some of those lessons and think about where they're living and the vibrancy immediately within their office district. So please reach out to us if you'd like to download the report, stay in touch. Thank you so much for your curiosity and joining. And we're looking forward to 2026. Have a great day, guys.
Thank you all for joining. Bye-bye.
Bye.